The IRS just released their new HSA limits for the 2026 tax year, which will increase tax savings for almost anyone who uses these types of accounts. A lot of people don't know this, but health savings accounts actually have more tax benefits than any other tax advantage account right now. It is better than your traditional IRA, your Roth IRA, your 401k, and your 529 savings plan, and so on, because it is one of the only types of accounts that will grant you a tax deduction for simply putting money into it. And it also allows your proceeds to grow tax-free in that account when invested. And it allows you to withdraw the proceeds tax-free when you use it for qualifying expenses. No other tax advantage account grants all three of these tax benefits at the same time. And that is why these accounts are so powerful. Plus, with the new IRS rules, you are now going to be able to get even more money into these accounts, which will only save you more money in taxes. So as a licensed CPA that tax plans every day at mycpacoach.com, I want to provide you with a very simple and easy to understand guide to help you get the most out of your HSA. So let's go ahead and jump in. Okay, so we will talk about how to actually set this up, but first, let's make sure you understand the major tax benefits here, starting with number one, tax deductible contributions into your HSA. So if you have a high deductible health insurance plan, which more than half of all plans are these days, then contributions into your HSA are tax deductible up to the maximum limits. In 2026, a high deductible health plan is defined as a plan with a minimum deductible of $1,700 for self-only coverage or $3,400 for family coverage. Now, as a CPA, I often talk to people about HSAs, and I have learned that many people do not know what their deductible actually is. And if that's you, just find your health insurance card, look at the front or back of it, and you will likely see your deductible printed on it. And if it is above these limits, you will qualify for a health savings account, which will allow you to save for future health expenses you may have while receiving a tax deduction at the same time. And starting in 2026, the new IRS rules will allow you to put up to $4,400 into your HSA if you have self-only coverage, or around $8,700 if you have family coverage. Plus, individuals who are 55 years or older would be able to make an additional $1,000 contribution to their HSA in addition to these limits, or $2,000 in the event that you are married and both spouses are over the age of 55. But in reality, how much money in taxes does this one tax benefit actually save you? Well, let's see. Someone in the highest tax bracket of 37% would save over $3,200 in taxes by simply moving $8,700 into their HSA as of 2026. And this is money that is still in your control. You can invest it, you can spend it on qualified health expenses as they come up, and more, which we'll talk about in a moment. But the first tax benefit here that you need to know is that you will instantly reduce your taxes the very moment you move a single dollar into your HSA if you qualify. Now, let's take this a step further and talk about tax benefit number two, tax-free investment growth inside your HSA. So as we move money into our HSA every year, we don't have to just let it sit there and do nothing. We can invest those dollars into various assets that rise in value, like stocks, bonds, money market accounts, and so on. And as those assets generate gains and income for you, guess what? Those gains are completely tax-free to you when they are generated inside your HSA. Normally, when you sell stocks at a gain, you pay capital gains tax. When you receive dividends, you pay dividend tax. And when you receive interest income, you pay tax on that income. But when all of that happens inside your HSA, all of those gains and additional income are tax exempt. Now, this is very similar to how a Roth works, except the fact that a Roth is funded with after-tax dollars that has already been taxed before that money went into that account. But with your HSA, you're actually funding it with pre-tax dollars and still getting tax-free treatment on your investment, which is why these accounts are so powerful. Plus, keep in mind that you do have the magic of compound interest on your side. For example, an $8,700 annual investment into an HSA would be worth over $1.5 million over a 30-year period, and a 10% rate of return. So the moral of the story here is, don't just let your HSA funds sit idle. Create a plan to either spend or invest those dollars to not only maximize your tax benefits, but your net worth and your wealth at the end of the day. HSAs can be a powerful wealth building tool. But speaking of tax benefits, we also can't forget about number 3 here, tax-free withdrawals when you use HSA funds for qualified expenses, which is what makes this type of account so unique. So usually when we put pre-tax dollars into a retirement account, like a traditional IRA or traditional 401k, we pay tax when we withdraw those funds later when we retire. But with an HSA, you can withdraw those funds tax-free when you use those funds to pay for qualified health expenses. And what qualifies as a health expense under IRS rules is actually pretty broad. Most people are actually surprised at what actually qualifies here. So let's touch on that for a second to make sure that you can get the most out of your HSA. So many people think that HSAs only apply to doctor visits, dental visits, prescription drugs, and medical procedures. And all of that is absolutely true and can be useful, but that's only part of it. You can also use HSAs for things like chiropractic treatment. And in some cases, you can even use it for massages, as well as therapists, psychologists, as well as certain weight loss programs. You can also use it to buy certain items from convenience stores, like health products from CVS and even Amazon. For example, Amazon has an entire section of their website dedicated to HSA eligible purchases. Now, according to the IRS, qualified medical expenses are the cost of diagnosis, cure, mitigation, treatment, or prevention of a disease. And if your expense does either one of these things, then it may be HSA eligible, especially if it is prescribed by a medical professional. And these qualified expenses do not just include your expenses that you incur for yourself, but it can also include medical expenses you incur for your spouse, as well as any dependents that you claim on your tax return, like a child or a parent, for example. Now, with all of that said, how exactly can you go about setting up your own HSA? Does it have to be through your employer, through a business, or can you actually set this up on your own? Well, you can do it through either one of these methods. If your employer or your business offers an HSA to you as a benefit, you may be able to take advantage of that HSA without setting it up on your own. But if they do not, please know that you can in fact set up your own HSA on your own. Many major banks like Bank of America, for example, offer HSA accounts. Plus, major brokerages like Fidelity, for example, also offer HSA plans that you can set up as a regular, ordinary individual. As I stated earlier, the only major requirement for this is that you must have a high deductible health insurance plan. And some people choose a high deductible plan for this reason alone, plus the fact that these plans typically have lower premiums and are also more affordable. But as always, please be sure to do your own due diligence and consider your own health situation. Consult a financial advisor or CPA if you need to, in order for you to make the best decision based on your unique situation. And if your tax professional is not helping you make proactive decisions like this to keep your taxes down throughout the year, just apply to work with my team of CPAs today at mycpacoach.com.